and welcome to this week's On the Spot. My name is Kevin Hill, here with Tony Mulvey. We're going to dissect the trucking market, the spot market, a lot of activity in that. Let's set the table, though, with the first graph up here, and that's our contract to spot spread.
Yeah, so this is the difference between our NTIL, so our base line haul rate, and our van initial contract rate per mile. And what you're seeing really is this, it's kind of at this lowest level that it's ever been. I mean, it's even lower than what we saw in 2020. But you see, looking back there in the green, so I've set it basically the baseline at 0. So where that line haul and the contract rate would be equal, would be 0. 2021, you saw spot above contract throughout the entire year, and even to start this year. And then we saw it kind of shift gears there in early February, and we've been on this decline as spot rates have fallen and contract rates have stayed relatively stable at these high levels.
I think as of today, we're about 85 cents.
Yeah.
I can't see the exact number up here on the chart, but I think it's 85 cents. Disparity between that and yeah, you said it correctly right there, Tony, is that's the reason why spot rates lead contract rates. And we're seeing downward pressure all over the market on that. So I would expect that contract rates will see a decline the next kind of rollover bids.
Yeah, I mean, you haven't seen it happen yet, but it's definitely going to happen. It's just a matter of when does that actually occur. I think
it just takes time.
Yeah, I mean,
it's got to marinate.
We've talked about it before here on the spot. It's what, that 60 to 90 day time frame from where spot turns over from contract. We're probably a little past that. I mean, if you look at this, we're a little beyond that, but I mean, you think about how crazy the market's been, it may take a little longer than what it may have done in previous cycles, and we were at such high levels.
It probably does, and contract pricing usually is delayed a little bit, so there's a little bit of lag in the reporting time when you're talking about that contract rate. Spot markets, real-time data that we have through Track, 1 day delayed. Let's go to the next chart here and talk about
ocean volumes.
Ocean volumes, right?
Yeah, they've fallen off a cliff. I mean, they're down 30% in the past month.
So and this isn't Shanghai, right? This isn't a Shanghai to the U.S. This is all ports everywhere. We're talking China, Vietnam,
Japan,
Europe, you know, all the big trade partners, and we are seeing just a massive decline. Do you have any thoughts about that?
I do. I mean, we talked about Shanghai. Shanghai's got the highlights, but this is showing that global freight movements are slowing down. And I think that's the key. This chart is true volumes leaving the ports on the day of departure. So what you're seeing is actual volumes leaving, and you're seeing that decline. And what's that mean is, I mean, that all turns to domestic freight at some point.
It does. It turns to domestic freight with a lag time. Everything has a lag time in transit. So that's what we're looking at, and we're seeing a huge, you know, it was 30%, did you say?
Yeah.
30% drop in late May, so that doesn't give us a great indication that there's going to be any uptick in volumes or activity in the spot market going forward. If we go to our next chart too, and we look at intermodal rates compared to NIT, both with fuel and without fuel, we were seeing that the intermodal is strong, and that's because there's not really this expedited demand.
Yeah, so in this chart, you've got your NTIL, that fuel, basically what we were comparing contract rates to in the blue line. In the orange line, you got just the NTI, so that includes those fuel, that all-in rate. Then you have our intermodal spot rate, so that 53-foot container door-to-door move, so it includes everything. There in the green line, kind of right in the middle, right? So you're still getting the discount on the intermodal side. And what you've seen is this but this time-sensitive nature of freight kind of dissipate. We've talked about it ad nauseum about retailers growing their inventory levels to just extreme levels. I mean, we're talking 30, 40% up year over year. Granted, to remember with inventory levels, they are values, right? Because they're on the balance sheet, they can't really show it by number of items, but you can show it by value. So with inflation, there is some impact, but we're not seeing 30, 40% inflation. We're seeing down in that 10% range. So, I mean, you're still talking inventory levels extremely elevated even when adjusting for inflation.
They are extremely elevated. We have a table up here that we can throw up to show, year over year changes in inventory levels at some major retailers. This comes from earnings report, and we see the general merchandise. You have your Costco's, Target, Walmart with significant increase as well. I'd say double digits, but it's well into the 20s, sometimes 40% range year over year change. We are seeing the grocers, though, a different story, right?
Yeah.
They're running lower inventories, and that kind of, inflation, a slowdown in consumer spending on tangible goods, general merchandise. If you get into the really discretionary retailers, we're seeing even higher inventory year over year level increases, dollar amounts.
Yeah, and this kind of coincides with what we've seen on the intermodal volume side compared to truckload. Intermodal volumes, they act as a moving warehouse as opposed to truckload that's going to get there in a couple days, right? And they're using that longer transit time to their advantage so they don't have to put it on their books.
And that's exactly what they're doing. That's the reason why we're seeing a weak spot market right now, is that expedited nature of moving goods around is not as urgent at all compared to 2021 or even the back half of 2020. But that's all we have for today on the spot, talking about the spot market. We'll be back here next Wednesday on FreightWaves Now to give you more insights. So take care, and we'll flip it over to a break and be right back.